Good morning, everyone, and welcome to the Ankerstar Wealth Morning Show. I'm your host, Allison Ankerstar, and today we'll be talking about where to invest now, what a potential ban on TikTok would look like, and the details behind a covered call strategy. But before we begin, as a reminder, this is a financial education presentation and should not be construed as personal financial advice. Full disclaimer information is available at ankerstarwealth.com. Good morning, Steve. What would you consider the best areas to invest in now?
Well, good morning, Allison. Good morning, everyone. Where to invest now is something I deal with on a daily basis, right? So where are we for the market? 2022, obviously a disastrous year for the public markets, right? You had the inflation's the problem, raising interest rates is the cure. Even last year, Blackstone said, what if we do all this interest rate raising and the rates don't go away? And inflation doesn't go away. I misspoke there. So what if we raise rates and inflation doesn't go away? Where would the public markets be now? And we're kind of seeing that. And their point was, consider private equity because obviously it's not subject to that, right? Because it's longer term investing. So when you think, so that was 2022, market sold off about 20%. Now 23, we kind of bounced a little bit thinking things would be better. It is not better. Looks like we're going to need a couple raises remaining. So therefore people are like, what do you do with money right now? Well, probably the most complex answer is private equity, right? I have relationships with Blackstone, Cantor Fitzgerald, some other folks out there that if you're looking to invest like institutions, again, this is long-term money where you don't put it in and bring it out every few months, right? You put it in, BREIT, BCRED, those sorts of things. You put the money in and then it stays there year over year. And you don't see nearly the fluctuation. You see hardly any fluctuation at all. BCRED pays out about 8%, BREIT pays out 6%. You do have to be an accredited investor to get in on that. So there are some qualification requirements. But certainly if you're sitting there at the $1 million level, consider a portion of your portfolio into private equity to avoid the big swings of the public market. So that's the most complex answer. Second answer is simply buy stocks when they're on sale, become a lifelong investor. Many of you are already, and you realize when you look back in time at 2008, 2000, those are times where if you had the stomach for it, those were the times you would have benefited the most if you could buy during those times. Guess what? We're in that time. It's tough when you're in the middle of the storm to think that this is the time to buy, but it certainly is, right? That's why you're seeing me and the team making some changes in your portfolio across the board. If you stay ahead, this great conversation with a client yesterday, if you stay high risk, you're buying more right now, right? And then you'll benefit from it, just like we did in 2020, the big sell-off during COVID. Is you wait, buy, and then the stocks go higher. So again, continue to accumulate during this phase is probably the medium strategy. The safest strategy is to go into CDs. You've heard me talk about the yield curve. Again, here it is. Again, you could talk for hours. Like I've said before, if you understand this chart, you could pass an entire college level economics class, right? So there's a lot going on here for such a simple chart, but this, short-term rates are to the left. Look at the bottom, 1 month, 3 month, 6 month, 1 year, 2 year. Obviously, this is not a perfect chart as far as it's a representative type chart because the time frames change across the bottom. This is a 2 month difference. This is a 10-year difference. But the important part to see is this blue line is where are the interest rates. So right now, the most interest you can earn is on a 6 month CD. You can earn 5.2%. So if you want 3 months, you're like, you know what? I just want to lock my money up for 3 months. You can get 4.9%. If you want to put it away for a year, you're still looking at 5%. I do have a couple of 18-month CDs that are still paying 5%. So again, think if I want to lock my money up for a certain amount of time to wait for the storm to pass, and again, you're guessing, obviously we all are, about when the storm will pass, but the market's undefeated historically in the storm actually passing. The end of the world has not happened yet. So the markets come back at some point. So how much do you want to lock in here? I will say that if you are a long-term investor And back when interest rates are zero, if you and I had a conversation that said, well, if I could just get a 4% guaranteed return, I'd lock that up for 10 years. You've got it, right? It's right here. The 10-year, if you saw the headline, just went above 4%, meaning right now, today, you can lock away money for 10 years and get 4% a year for 10 years. Exactly what you want is available today. And you're like, I'm not going to do it. I'm going to go here at 6 months and get 5.2%. And then 6 months from now, this part of the yield curve has dropped down to, 4.2. And then the 10 years back down to 3.6. And you're like, oh, that's why I should have considered locking it up. So people are like, why would I lock up for 4 if I can get 5.2 now? And I'm like, well, this is greedy short-term thinking. This is man, I would love to have that for the next 10 years. Or look at the 20. This is obviously a weird blip in the chart, but again, so is all this part. But you could find a 20-year CD where you lock it up for 4.17. It's available today. In the next 20 years, you get 4.17% on your money. Okay. Obviously, the market's going to outpace. Well, not obviously. Historically, the market has always outpaced 4.17% annually over 27 for over a 20-year period. But if you want a portion of your money in safety, this is the way to do it. That's long-term. This is the short-term stuff. So again, if you got money sitting in the bank and it's over like 25,000, and the bank's paying you 1%, and you could be getting over 5% for short-term, that's honestly, that's on you, right? So you need to think about that. That's what the bank's doing with your money, and the bank just keeps the money, right? So that's how you have small towns with 1 McDonald's, a Walmart, and 7 banks. Right, is people don't understand this concept. If you have money sitting in the bank, you're like the bank's favorite customer, right? Because they can make money off your money and pay you just a little bit, but they make a lot. So consider. So places to summarize, where to invest now. If you're interested and qualify for private equity, I believe you should be in on it. I own it through the business. I own Blackstone stuff through the business. I own Blackstone stuff personally. It's a great place to be. Secondly, just continue to do your thing in the market, accumulate shares while you're low or while the markets are down. Or third is just consider CDs, whatever you want. You can go short term and make more. You can go longer more and lock it in. It's kind of your choice. But those are the 3 things that are the places to invest right now.
Next, lawmakers are pushing for a U.S. ban on TikTok. What do you think that would look like?
Okay, so TikTok, there is so much hyperbole, if you will, in the mainstream media right now about China. They had balloons floating over the U.S. We let them do it and then decided that was bad and shot them down. Anyhow, and all the talk of defending Taiwan and all the 2 presidents butting heads in the media. We the U.S. consistently say that China is warmongering and trying to kick off World War III. Well, if you have the ability, and honestly, most people don't, to sit back and look at what's actually being said, it seems like there's a lot more crap talking coming out of the U.S. than there is coming out of China. To be honest, it's all we talk about, right? It's like China, like we're trying to start something. Right. It's kind of like the recession. If you talk about it enough, you're going to make it happen. Right. Because people are going to believe because that's all you talk about. So let's stop talking about recessions nonstop or war with China nonstop. You can actually make everyone believe, and then it happens. And that would be tragic for the world. I mean, tragic. But back to the point of TikTok being a Chinese firm. ByteDance is the parent company. Everybody's concerned that they're going to steal what I had for lunch today off social media, and that's going to be a game changer. But I mean, I get it. I get the concern. I don't personally share that concern. I really don't. What the stuff they're gathering off of TikTok, I'm on there every day. I check it out. Okay, yeah, that's not game changing stuff, right? In my mind, there's other people that are making a mountain out of this, and it's a big deal. So what would a ban look like? Well, there's an outright ban, like no more, you can't have the app. And some I think it's some companies or some, like the government has banned it at work or something like that. So there are some smaller bans out there. There it is. Several governors have removed the app from state computer networks, including public universities. Okay. And people are calling for a nationwide ban. Well, it either goes away. That's unlikely. right? Because so many people are, dependent on it. It's a big part of their day, whether it's entertainment or making money. Don't forget, there's, a lot. I don't know what the number, if it's in 10,000s or hundreds of thousands or millions of people making money off of this thing. But a lot of folks, I mean, could you imagine the government rolling in and invalidating the business model for the influencers that make that their livelihood? They quit college because of TikTok, and all of a sudden the government comes in and goes, nope, out, right? It's like, oh crap, that doesn't work, right? So I don't think it'll be an outright ban. I do think that it will force a sale of some sort, and that's what either you don't know these things, but either Facebook, now Meta, or Snap could buy or be forced to buy TikTok, or TikTok splits into a US only portion and then the rest of the world. I don't know. There's a million different scenarios out here, but I don't think TikTok's going to go away. I think it could merge into something else. And of course, if it's bought by, Meta or Snap or some other firm that buys it out there, Apple, whatever, is that now there would be a new set of rules on data and privacy and sharing and all of those things that would now put those concerns to rest, that we're just sitting there giving our personal information to China. So I think probably something's coming just because of the relationship with China. No idea exactly how it's going to be, but it could be a boon, is what this article is saying, and I do agree, for Meta, Snap, or other social media companies out there, depending on how it actually is executed.
Last, covered call strategies are pretty popular to generate income on long-term holdings. How do you use them?
Sure. So first of all, what is a covered call strategy? So I should have had that up here, but we'll just pop it up here on Investopedia. So covered call strategy, it's kind of complex, but let's get rid of this big ad. Kind of complex, but basically, if you hold a position, so 100 shares of Apple, you can cover it. So you create an option, which literally you can create out of thin air. Conceptually, right? It's like pulling out a piece of paper. It's like a big coupon saying, here you go, Allie, I will give you the option to buy my Apple shares they're at 150 today. You can have the option to buy them at 160 a year from now. And then if you agree, you buy that contract from me. So you give me dollars, like out of your pocket into my pocket, for having that contract. Now, a year from now, if Apple's above 160, say it's at 200, then you make, $40 a share times 100, that's $4,000. If it's below $160 a share a year from now, your coupon to buy those shares, you wouldn't execute, it would just expire worthless, right? Because if shares are at 155, you wouldn't buy them for 160. So it kind of just goes away and expires. That's the basics of covered call. Now, there are ways, if you have a large position of, say, Apple, and you can't sell it for tax, because it would because you've held it for 20 plus years, and it would be entirely a taxable gain. So you kind of going to hold it the rest of your life. This allows you to make what's called the fifth dividend, right? You get dividends every quarter. This allows you to make some more money on top of that, generally from anywhere from 1 to 5% a year, depending on how aggressive you are with the option strategy out there. So if you do this, and I used to do this for clients when I first started working, and I've stepped away from it. 2 reasons: time consuming to get this exactly right. So you kind of you want to outsource it, to be honest, because it's so time consuming. So I'll talk about how we do that. And then secondly, clients don't necessarily understand what the option and the pricing and stuff. So you end up spending all this time talking about an option, and if it goes the wrong way, then you have to explain that, and people don't like it. So I've honestly just really stopped and just waited for them to expire. I still have my stuff covered. I think it's a great way to make a little extra money, but I digress. So to outsource it, how do you outsource it? If you've noticed in your portfolio, we have 2 basically premium income ETFs. Premium income in this case means that they're generating extra income by using an aggressive option strategy. So they're capturing the volatility of the market. Not to get in too deep into options, but options get more expensive when a stock's moving, right? Well, the whole market's moving right now. We don't know whether it's going to go higher because the Fed comes out here later in the month and goes, nope, we're not raising interest rate. Market screams higher, right? 10+%. Fed comes out and raises 50 basis points when 25 is expected. Market goes down 5%. So that's a market, let alone individual stocks, which have lots of other drivers out there. But The point being is you can generate a lot of income off of this. And then, they pay that out. So when you look at JEPI, which is the primary way that we have it, it's kicking off a 12% yield. So it's generating, think monthly terms, is generating an extra percent a month, and it's paying that out to you. Okay, it's down 2.44% on the year, but it's also paying out 1% a month in income. So you're making money over a long time, and it's, it may not be able to do that forever, but it can certainly do that during the heightened volatility time. So that's one. JEPI, that's large cap stocks. You have the same thing with small and mid cap stocks, or SMID cap is the term in the business. Come on, JEPQ. There it is. I don't know why it's not popping up directly. These things do go up and down with the market. There's the 1-year chart, but JEPQ is paying out 12.65%. So between these two holdings, you have money coming in monthly. And you're like, Steve, what do you do with that money? And I'm like, well, that gives me cash to turn around and execute. If you remember, what to buy now strategy is, first of all, this buffers your whole portfolio. So your gains and losses are less. It's a little more stable because you have these holdings. But when you tell what to invest in now strategy, well, not going to put in, say you have $50 a month coming in, that's obviously you're not buying private equity with that, and it's not enough to buy a CD. So it's that middle one, right? You turn around and you buy stocks while they're low. So even if you aren't putting in new money, people are like, well, how can I buy low? I don't have any more money. It's all in the market. Well, these things that are generating income are now putting cash in your portfolio. So I literally every day am a net buyer of new stocks. So I'm buying low on your behalf. So that's what's going on behind the machine. So covered calls, again, what are they? Options above stuff that you already own where you can make some extra income. How do you outsource it? JEPI and JEPQ. And what are the benefits of having those in your portfolio? Is it generates cash, spits out cash into the portfolio, into your cash balance. So now I can turn around and buy other stocks that I like while they're on sale.
Thank you, everyone, for your questions. Please submit your questions as a comment through social media or directly to our email at vipservices@ankerstarwealth.com. And don't forget to like and subscribe to get daily updates. That's all we have for today's show. I'm Allison Ankerstar, and we'll see you back here tomorrow.